performance. Today we're going to be going over the final type of analysis that you can do for your assignment that's due at the end of November, right before Thanksgiving. And I encourage you to listen to these slides a couple times through. I also highly encourage you, before you get started, to print copies of these slides off. I think it will make doing the calculations easier for you. I've found in the past that when students don't have them printed off, they often get lost, and it's not an efficient use of their time. So I just highly recommend that you print off the slides and pause the lecture when you need to, in order to confirm that you have gotten to the number that I've gotten to. And in addition, if you have any questions, please email me or also dial in for office hours. Thanks so much, and let's get started. So just to confirm, and we've talked about this in the past, but there are three types of analysis. There's ratio analysis, which is something that we have gone over already in this course. You just submitted an assignment where you use ratio analysis. Then there's vertical analysis, and then there's horizontal analysis. So today we will be discussing in-depth vertical analysis and horizontal analysis. But I think it's important for everyone to understand that these three types of analysis is how organizations, evaluate and use their financial statement and the information within the financial statement to help make decisions. So the first learning objective is to describe the purpose and uses of the horizontal and vertical ratio analysis. An important definition that you should know, could potentially be an exam question, is what is horizontal analysis? So horizontal analysis refers to the studying of behavior of individual financial statements over several accounting periods. So this can be month over month. It can be looking at a month-to-month basis. So what was the change from January 31st to February 28th? What changed within certain financial statements. You can also look at it quarter to quarter. So what changed between the end of quarter one and the end of quarter two. And then you can look at it year over year. So 2010 to 2011, comparing those two pieces of data, and studying those outputs to understand the behavior over a period of time. Horizontal, vertical, and ratio analysis. Again, horizontal analysis is a trend analysis that's conducted to help financial statement users recognize important financial changes that unfold over time. So, based on what we saw on the earlier slide, I use the term trend analysis, referring to studying the behavior of financial statements over time. And this definition just further helps us understand that we're looking at the changes over time, and that is going to tell us what's happening. So if we want to look at gross profit between 2012 and 2013, so 12 to 13, you're going to look at the change in gross profit in a dollar or percentage from 2012. And this is going to provide you a trend analysis. So, it's important to understand that, this trend analysis, you want to understand, what's happened in these accounts. And you generally want to do this sort of trend analysis for all of the accounts in the financial statement. So for all of the pieces of it. And the next important thing to understand is that vertical analysis focuses on important relationships between items on the same financial statement. So here is a partial income statement showing sales, cost of goods sold, and gross profit for the fiscal year 2013. While we know that the number amounts will appear on the income statement, we gain insight in the values on the income statement by doing vertical or common size analysis. So here we've calculated the percentages of each amount by expressing sales as 100%. The definition of vertical analysis is that vertical analysis uses percentages to compare individual components of financial statements to a key statement figure. So vertical analysis is also called common size analysis. And a common size financial statement is a vertical analysis in which each financial statement is expressed as a percentage. So lastly, ratio analysis. And ratio analysis is conducted to understand the relationship among various items reported in one or more financial statements. So, as you already know, you're going to calculate outcomes using different parts of the financial statement. So you can use inputs from just one or multiple financial statements. And it's essential to understand that, no analysis is complete unless it leads to an interpretation that helps financial statement users understand and evaluate the company's financial results. So the whole point of, using these three types of analyses is to give information to key decision makers who are going to use that information to influence where the organization is going in the future. And therefore, you want to make sure that the people that are using this information are able to interpret and evaluate these results. Objective is to use horizontal analysis to recognize financial changes that unfold over time. So first off, trend analysis is usually calculated in terms of a year-over-year dollar or percentage in changes. And calculating the dollar change from year one to the next year is actually relatively easy. However, calculating the year-to-year percentage change can sometimes get students a little bit lost. So if you're not someone that is good with numbers, or these calculations make you nervous, make sure you you memorize this formula and make sure that you know it and practice doing it. So here's the formula. So year-to-year change percent is the change in this year over the prior year's total times 100%. And that top number, change this year, is equal to the current year's total minus the prior year's total over the prior year's total times 100. And let's look at an example on the next slide. So here we have company X, and this is a income statement for company X. And we have fiscal year 2010 and 2011. And we are going to see the amount of change and the percentage of change. So why don't you stop at this moment and go ahead and calculate what you believe to be the amount and the percentage of change for net sales revenue. So that top number on the sheet. And we'll go ahead and stop the lecture. Okay, so now that you've done that, go ahead and go through. And so what we see, if you take the 48,815 and you subtract 47220, so the 2010 number, you get 1595. So there was a 1,595 million increase in net sales revenue between the 2 years. So if you did not get that number, go ahead and pause it and figure out what you did, and then get back with us. So next, let's go ahead and calculate the percentage of change between 2010 and 2011. 2010 and 2011. So you should have gotten to 3.4%. let's go ahead and put all of this data in. So to get to the 3.4%, you take the 48,815 minus 47,220 over 47,220, and you multiply that by 100, and that gets you to the 3.4%. I hope you're able to get to these answers. As I think that this is going to be very useful, and I expect to see this in the final, in your analysis for your papers for this class. So let's calculate the dollar and percentage change for cost of sales. So the next line, go ahead and calculate that, pause the slide and go ahead and calculate that. Okay, so what you should have seen an increase in $906. So that, and then that comes out to a 2.9% increase in cost of sales. So here's the rest of the trend analysis for the income statement, and we can apply just the same technique to the balance sheet and do trend analysis of that financial statement. In general, we don't see trend analysis done on the cash flow statement. If you're wondering why I didn't mention that, it's just a little bit trickier, and you don't have to worry about doing that for your paper. Learning objective is to use the vertical analysis to understand the important relationships within financial statements. So let's go ahead and get started with this. So the vertical or common sense analysis focuses on important relationships within financial statements. So we're going to look at the income statement for company X. So here we have company X, and in general, sales are always equal. So if you're wondering what to calculate these parts of the income statement as a percentage of, you always want to calculate it based on sales or your revenue, your revenue dollar amount. And so in this case, we have net sales revenue at the top, and that's going to be 100%. And so why don't we go ahead and have you sit and calculate what the cost of sales is for, why don't you go ahead and calculate cost of sales as a percent of your total. So to do this, you're going to do cost of sales over net sales revenue times 100. Go ahead and stop the slides, stop the lecture, do that. So now that you have calculated that, you should have come out with 64.9% for 2010 and 65.1% for 2009. So the next, why don't we do the rest of the common sense income statement for the 2 years? So here are the numbers for the 2 years, and if you didn't get to these numbers, then I would pause and go back and relook at the first calculation and make sure you can get to that. Now I think what you want to start doing when you see these numbers is you want to take the next step, and you want to say, well, why did this happen? So what we can see is that between 2009 and 2010, there's a fairly significant increase. So going from 3.8% to 4.1% as a percentage of net income is a fairly large, income and net income increase. And so what you would want to explain is why that occurred. We see gross profit went up. We see the operating and other expenses went down. Is that what contributed to it? Was there a decrease in the percentage of cost of sales? You want to look at this and figure out what happened within this financial statement, and better yet, within the organization that caused these changes. So In this case, what I would do is I usually like to start from the top, and I like to say, okay, I see this change in net income. It went from 3.8 to 4.1%, which is a good thing. Let's figure out what happened. Well, when I start at the top, I see on this case that cost of sales as a percent went from 65.1% to 64.9. So that's a 3-point drop. Um, and and that's actually a pretty good, drop. And so that could be contributing to it. So that means that maybe the organization was better able to negotiate contracts for the cost of sales. Um, excuse me. Next, I see, let's go to the operating and other expenses. So their and other expenses went down from 28.3 to 27.8. Again, they may be better able to reduce their operating expenses. Maybe they, maybe their rent went down for the building that they lease, and that contributed to less expensive. Maybe they decided to be more efficient and run a leaner organization and fired some people, and so therefore, the number of people, maybe they fired people in HR, and maybe, that contributed to a decrease in their operating and other expenses. Um, so, I'm just giving you examples of, how you want to use this information. You want to be able to ask questions and see that there's a difference and say, what could have happened in the organization that would contribute to this? So the next learning objective is to interpret the results of financial analysis. So, how are we going to interpret horizontal and vertical analysis? So, financial statement analysis are not complete unless you lead to interpretations that help users understand and evaluate a company's financial statement. So, that's really important to know for tests. I may say to you, I may ask in the final exam, you know, how is financial statement analysis complete? And you would want to say financial statement analysis is complete when they lead to interpretations that help users understand and evaluate a company's financial results. That is the exact answer that I'm looking for. Just a little hint for the final. So when you're going through and you're looking at this, horizontal or what we call trend analysis of company X's balance sheet shows that the company grew only a little in fiscal year 2010. Or excuse me, 2011. And overall, the total assets increased by just 2.1%. Um, this isn't, a lot of total asset increase. And so, you want to go through, and by the way, you should look and notice that the total asset increase equals the total liabilities and stockholder equity increase down at the bottom when you look at it as a percentage. So when you look at this, the most significant change that you can take from the balance sheet is that company X began relying more on debt and less on equity financing. So during during 2010, company X's long-term liabilities increased by 28.7%, which results in issuing $2 billion in new bonds. So as it's explained in their financial statement notes, the stockholders' equity decreased by 5%, largely the result of company X's repurchasing common shares. Now, what does this mean? How do you take all of this? I think that, you can't just look at these numbers and get to the answers you want. You have to go through the organization's notes, which are at the back of their audited financials, and you have to read all of the notes that come with it. They often explain what they did and why there were significant changes. And they do this in audited financial statements because they know they are going to be asked about it. They know that when people look at their financial statements, they're going to have questions. And any red flags, any big jumps or jumps either from a positive or even a negative are going to get questions about it. And people want to know. And they want to know, what's been happening in the organization that's caused these changes. And so organizations go ahead and they take the onus on them. They want to be in the driver's seat, and they put out the information that helps people understand what's going on. So, as we can see, company X began relying more on debt and less on equity financing. Long-term liabilities increased by 20.7%, and stockholders' equity decreased by 5%. So, these two are related. If you see an increase in your liabilities, in your long-term liabilities, there's something else is gonna have to move, either your current liabilities or your stockholders' equity. So Company X's assets also grew only by 2.1% in fiscal year 2010, as I noted. So on the next slide, we want to be sure that we also look at the income statement. So Company X, when you first look at this, experienced a small decrease in its percentage of cost of sales in relation to sales revenue from fiscal year 2009 to 2010. And decreasing cost of sales generally results in a higher gross profit, or in this case, it resulted in a higher gross profit. So, how was this able to happen? So what we can assume, or one thing we can, kind of guess, is that the management at Company X was better able to control operating expenses from 2009 to 2010. And operating expenses are a really big deal for organizations. A decrease by 5% during the period is a really good thing that to have happen in an organization. And one way that people reading this statement might evaluate this is by saying that the management was more effective in managing costs and operating expenses. So again, what that means, or not again, but when I say that the management was better at controlling operating expenses, this means that they may have been able to become more efficient in how they produced the goods that they were producing. Maybe they were able to use less workers to get the job done, and therefore were able to let some people go and didn't have to have the same expenses. But this is a really big deal, and something that, people analyzing, especially outside organizations, want to see. You want to see, or that organizations are focusing on their operating expenses. They're not, spending money that doesn't need to be spent, just kind of willy-nilly. And, I think when you read the newspaper, when you read things like the Wall Street Journal or the New York Times, and you go to the business section of the New York Times or the Washington Post, and you see these headlines that say, I don't know, some company is letting 500 employees go, or they're closing one of their facilities, or, things along that nature. That is all in an effort to control their operating and other expenses. Reducing the number of, plants that you have open to produce whatever you're producing is a way that organizations can reduce cost and do a good job of managing their costs. So it's one thing that you definitely, when you're looking at these, financial statements, you want to make sure that you're fully getting a hold of those. So again, cost of sales and operating expenses are the most important determinants of a company's profitability. So here we have cost of sales at 64.9% for fiscal year 2010, and the other and operating expenses is 27.8% of net sales revenue. When you look at this, the increase in net income in fiscal year 2010 is explained by the increase in net sales revenue and the decrease in cost of sales and operating expenses as a percentage of sales. So just to make sure everybody got that, the increase in net income in fiscal year 2010 is explained by the increase in net sales revenue and the decrease in cost of sales and operating expenses as a percentage of sales. So that's what we're contributing this 4.1%, the change between 4.1 and 3.8. So next, we're going to look at Company X's um, net income or income statement. And when we go through this, what we can see is that Company X has experienced a small decrease in its percentage of cost of sales in relation to sales revenue from fiscal year 2009 to 2010. And what ends up happening is when you see a decrease in the cost of sales, or some people also call this the cost of goods sold, the COGS, um, then this usually means that you're going to have a higher gross profit. And what ended up happening in addition is that Company X did a better job of controlling its operating expenses between 2009 to 2010. So if you see in fiscal year 2009, they 28.3% of their net sales revenue went to operating and other expenses versus in 2010, only 27.8% went to other operating and other expenses. So we would say they did a better job of controlling their operating expenses because it contributes to less. So it's important to look at each variation and explain the variations. The key to doing variance analysis is to not just calculate the numbers, but also have notes that explain what this is happening. And, the key to this is having very detailed, accurate explanations. And if you are in a business unit and somebody else is doing a financial analysis of your unit, people may ask you, what happened? Did your sales go down? What happened here? Did they go up or down? And you're expected to give very detailed explanations. And some of these explanations in general can be, did you have a declining or lower than expected sales or revenue? Did you see declining gross profit or perhaps increasing gross profit? Did you have a significant one-time expense? So, sometimes if you're in a healthcare organization and you lost a large lawsuit, you may have a large one-time expense for a lawsuit. Did you see an increase or a decrease in the cost of raw materials? So if you work for a firm that produces something, so Apple, for example, they may see a decrease in the cost of raw materials, which will cause them to have a better margin. Do you have an increase in personnel costs or decrease in personnel costs? Or you could also say that's a cost of labor fluctuation. And last but not least, was there a large divestiture or merger that caused you to have a difference in your in your results year over year? And when you're looking at audited financial statements and you are not within an organization, you're asking these questions and you're doing this variance analysis. So this is specifically a note that is helpful for those working on the financial statement paper that's due soon. The answer to a lot of these are in the notes of the audited financial statements. These notes give you a tremendous amount of detail. Organizations, put out these notes so that you can have an explanation for why there was a change year over year in what happened in an organization. They're trying to, avoid questions. They'd rather a lot of times get out in front of the questions and put the information out there. And so if you're wondering, what's happening within the organization that you're doing the financial statement analysis of, I encourage you to really read the notes with a significant amount of, in detail, because they will give you the answers a lot of times, or they'll help you understand exactly what happened and come up with an explanation. So with that said, this ends this part of this week's lecture. Don't forget there is another slide deck for you to listen to. This isn't the only one. Both of them are about 30 minutes long. I encourage you to listen to this lecture a couple of times, to take diligent notes. You're expected to know all of this for the final. Thank you and have a great week. Bye.